let me just quickly, while Adam figures out his technical situation, let me just briefly explain the format of these sessions so we relieve Adam's time. Adam is the chair of the session. He will then call upon you during the main part of the discussion afterwards. But what we've decided is that everybody has about around 10 minutes of discussion time, presentation time, followed by one of the panelists discussing somebody else's presentation. And I think if I look at the schedule, I think it's Alex Howlett with Project Greshm, who's starting with the very first presentation. And I believe it's Asgeir Torfason, who is with the Fiscal Council of Iceland, who will be his discussant. So we have about 10 minutes, Alex. Do you need are you sharing a PowerPoint? In that case, I will.
Yeah, I can share from my end.
Can you hear me now?
Okay, Adam, the floor is yours as well.
Okay. So I have another additional computer with me, and sorry for my background. So I will just change my background because I was preparing for myself the unforeseeable, and sorry for this technical issue. This is a great pleasure for me to chair this session, and I really thank you for Celine for this very nice presentation. And I'm very happy to have three great panelists. And as Jay mentioned, the order, so Alex is going to start, and his discussant will follow a 5 minutes discussion, and then Maria will continue with her presentation, and then finally Asgeir is going to be the third and last presenter of this panel. And just very briefly, let me introduce myself. My name is Adam, and I'm a coordinator of the Financial Stability Working Group. We had the pleasure to organize a course for MoneyView, and as I just watched Perry's session today, and he mentioned an intellectual journey, and let me say that this is this symposium should have been either in Bretton Woods or in New York, but now it's in Bretton Zoom. And without further ado, let me just give the floor to Alex.
Okay, hi guys. So I'm Alex. You guys all know me from a few minutes ago when we were arguing about stuff. But for people who just joined, my background is that I'm kind of just an independent thinker. I got into learning about economics and learning about monetary economics because I was interested in basic income. So here's my talk. Let me see if this works. Cool. Oh, I can resize my head. I'm gonna do that really quick. If I can figure out how. Yeah, here we go. Yeah, all right, now you guys can see me. So money. What is the deal with money? So this is a talk about the basics, but it's about my version of the basics. And if you want to connect the money view up to the price level, this maybe can be an interesting starting point. So, next slide here. So it will always be true that a market economy requires a fixed frame of reference against which to set and pay its prices. That's money. Money is two things. It's both the standard unit in which markets set their prices and also the standard value tokens we spend to pay those prices. For the purposes of this talk, the unit is what I'm going to call the currency unit, and the tokens are money tokens. You spend your dollars, money tokens, to pay dollar prices. A $5 note can purchase a $5 sandwich. Money is what we spend to buy stuff. The adoption of a single pricing standard allows market participants to speak each other's language, as it were. Money, specifically the currency unit, functions as the language of trade. This is why money exists. Without a common currency unit, markets can't set prices, supply can't meet demand, and trade breaks down or fails to establish itself. Whoops. With good reason, history has never seen any large-scale economies with goods priced directly in terms of other goods. Be it ounces of gold, dollars, or something else, the market will coordinate on a pricing standard. When we describe money as a medium of exchange, we're really talking about money tokens. These are the easily traded objects that represent a fixed number of currency units worth of purchasing power. Money tokens are what resolve the double coincidence of wants. Everybody wants money tokens. They serve as a useful intermediate exchange medium precisely because they're denominated in the pricing unit. Not all money tokens are the same. The hierarchy of money and credit that Perry Mehrling and all of us think about and talk about is really a hierarchy of money tokens. At the top of the hierarchy sits the base money token, which forms the basis for the currency unit. Subordinate money tokens, such as bank deposits and other forms of credit, are ultimately promises to pay base money tokens. Subordinate tokens are denominated in the standard currency unit and, in many contexts, are freely interchangeable with base money tokens and with each other. The base money tokens and the subordinate money tokens are all ultimately the same kind of thing. In his paper, The Inherent Hierarchy of Money, Perry Mehrling says, we want to avoid sterile debates about what is money and what is credit, and stand instead on the point that the system is hierarchical in character. When people save money, there's supposed to be a slide up here that says money as a store of value. When people save money, they prefer to hold assets that provide a positive return over time. That is, you won't get the best bang for your savings buck by stuffing cash in your mattress. In his Money and the Mechanism of Exchange, William Stanley Jevons says, money is made to go. People want coin not to keep it in their own pockets, but to pass it off into their neighbors' pockets. Another way to put it is that money is the thing you spend, not the thing you save. Most people aren't going to save money by stuffing it in mattresses. But maybe they would if those mattresses paid interest, right? Well, that's what treasuries are. Treasuries are mattresses that pay interest. A money token that pays enough interest can serve as a decent savings instrument. But the money tokens that we hold for savings, like treasuries, are generally not the same ones that we spend for payment. People need to be able to reason about market prices without worrying about the unit in which those prices are expressed. And ideal money remains as neutral as possible. It sits outside the influence of market forces. It is exogenously stable. In the absence of market-wide institutions, the market will tend to settle on a widely valued commodity as its base money. But government institutions, if available, are in a position to use macroeconomic policy to ensure a currency's stability. They can create a near perfect commodity for use as the market economy's base money token. Fiat money is really just a special kind of synthetic commodity money whose stability is managed by institutions. A well-managed fiat currency system will always win out against a natural commodity such as gold. Only with fiat currency are there institutions standing ready to push back against market forces that would otherwise move the price of the currency. If the state hopes to remain the issuer of its economy's base money, it must maintain a stable standard of value. This price stability constraint binds fiscal and monetary policy. If our institutions fail to honor this constraint, the market will find something else to use as its money. But there is a tension in the way we've set up our monetary policy. If we put the central bank in charge of maintaining the stable level of consumer prices, as we do today, then that limits what they can do with respect to facilitating the financial sector's smooth functioning, financial stability. For example, the central bank can't easily prop up consumer prices while simultaneously tightening lending conditions to prevent an unstable expansion of private credit. We know that subordinate money tokens, such as bank deposits, are promises to pay base money tokens. But in any monetary system managed by institutions, whether based on a physical commodity or a fiat token, base money tokens represent a promise too, the promise of price stability. So-called inconvertible notes are still convertible in the broad sense that the government is making a promise about what the market will sell you. And they're keeping that promise by using macroeconomic policy to ensure a stable price level. Base money tokens and all money tokens are promises to pay goods. The economy is a machine that produces goods and services for consumers to buy. Money tokens flow from consumers to producers to claim goods and services flowing in the opposite direction. A stable price level implies that the flow of money tokens, spending, remains proportional to the flow of goods and services, economic output. If one of these flows moves, the other must adjust to match. The important insight here is that managing the token flow doesn't mean just managing the flow of base money tokens. It means that institutions must manage general spending, regardless of whether those institutions issued the particular tokens being spent. Tokens all up and down the hierarchy matter. The so-called chartalist view of Georg Friedrich Knapp insists that the value of base money comes from the state and its laws. The opposing so-called metalist view insists that the value of base money comes from the intrinsic value of an underlying metal. There are certainly contexts in which either or both of these stories are relevant to the functioning of a monetary system, but neither one tells us about why money functions the way it does. A money token can get its value through a number of different proximate mechanisms, but what ultimately matters is that the value of the base money token, along with its accompanying hierarchy of subordinate tokens, remains sufficiently stable to serve as the basis for the economy's currency unit. Price stability helps us understand why gold and silver were appealing standards in contexts where institutions hadn't fully matured, and that includes international trade in the 19th century. The prices of these metals are reasonably stable compared to other commodities we might choose. In this sense, the metalists are right. But we can also sympathize with the chartalist perspective. Well-functioning institutions can keep a currency unit artificially stable. Then again, a poorly managed fiat money can quickly deteriorate to being worse than gold. We can only ascertain the essential nature of money by examining its necessary function in the economy. Money is what it does. It is defined by its function. Legal history can describe the process by which our institutional machinery came to be, but it cannot explain the underlying reason for money. Ultimately, neither side sees the forest for the trees. Chartalism and metalism are both wrong. The nature of money derives neither from the state and its laws, nor from commodities and their physical properties. The nature of money derives from a computational complexity problem that any large-scale economy must address. Perry Mehrling's money view examines the plumbing of the money tokens, which appear as assets and liabilities on the financial sector's balance sheets. He emphasizes that abstracting away from this plumbing misses essential insights about the constraints that financial markets face. Instead of treating money as a veil to be seen through, the money view treats money tokens in particular, as the central object of study. We do need to be aware of the plumbing, but only in contexts where we face the costs and constraints imposed by the veil. Money's defining characteristic is that the goods market can use it as a neutral standard of value. Its veilness lies at the very heart of its function. There are many answers to the question of what money is, but there is just one answer to the question of why money is. Only by examining the primary function of money can we understand the implications of and the limitations to manipulating it. The market will find a stable standard value unit of account against which to set its prices, along with corresponding standard value tokens with which to pay those prices conveniently, and to borrow and create debts and all of that kind of thing. Money's price stability can originate from the promises and actions of government institutions. It can originate from the universally accepted value of a particular commodity, or from a combination of both. The purest form of money is whichever one the market chooses. We don't want our money to get in the way of our real economy. So how can our institutions manage our money such that our desired social outcomes are constrained only by our economy's real productive potential? Properly functioning money allows prices and quantities to adjust in individual markets. But at the level of the macroeconomy, prices, either real or nominal, cannot adjust. The price level cannot adjust, especially the real price level. So quantities have to do the heavy lifting. But how can quantities adjust when the price level is fixed? And why would they? By understanding money's function as an exogenously stable building block, we can begin to fruitfully explore these types of questions. Thanks.
Thank you, Alex. It was great. I really learned a lot about this really interesting and actual topic. Let me ask Asgeir. Asgeir, can you please briefly discuss Alex's paper, and please also introduce yourself to those who don't know you. Let me just tell that you are a member of the Budget Council of Iceland, and also a professor of the MoneyView class. And the floor is yours, Asgeir.
Yes, thank you, Adam, and thank you, Alex. And I will present at the end of this session. I will use my 5 minutes to briefly comment on this good overview presentation, and I encourage you to read it. It provides a good overview, but I will be critical. You know, I am educated in the philosophy department, so I will point at the points that where I don't agree so much. In order to improve it, and it's a gift to give a critical criticism. So I agree with much of the overview, and it builds on Hicks that I know, you know, the last book of Hicks, 1989, that I know Perry builds on as well in his course. So I recommend reading that book as well. So the point where I am a bit unsure what you mean, or where you need to either think through more or spell out more clearly, how is the money supposed to be managed and by whom? I kind of implicitly get from your concluding comments that you believe the market should do that based on some kind of real resources constraints. And then, you know, we need some kind of a system or institution to do that. So my question there would be, is that the central bank or some market forces, or are we going into some kind of self-governed stuff of some kind of electronic algorithms to do that? And then before I will use my 5 minutes, and then you can react. So built on that, but let me say this point is like connected to my belief in Kindleberger and Kindleberger's view on that we need some stabilizer of last resort, or, you know, and we see it that, you know, for example, in the COVID crisis and in March 2020, last year, even when we go out of the country-wise or central bank-wise area, the market freaked out and someone had to step in, and it was way out of bound of some real value. And it was actually run for money, and the highest hierarchical money, even from US treasuries to US cash, you know. So that's one critical point. And then to complicate it even more, when you say that you criticize that the legal aspect is not enough. There I would like to disagree also, and just point you or the other audiences towards the legal theory of finance by Katarina Pistor, and specifically the recent book of The Code of Capital, where she actually goes through the history of the legal constructions of 400 years, explaining, you know, how the creation of capital can be done through the legal constructs. And I'm looking forward to listen to Maria's presentation later on. But this is where we are on the intersection of money and capital assets, and how you can create money even outside of the banking lending, which will be in my presentation, like the simple banking credit creation of money. Then my final point, because I think I'm running out of the money, running out of the time, and I really like your point on the price stability, and that's then linked to the time value of money in some way. You talk about nominal and real. And this is definitely a critical issue not covered in the course by Perry if you have the 4 prices of money. So this is definitely that needs to be worked on and can be built on in your paper by yourself and others, and criticism of it. There, my main concern is that if you bring in the FX, the foreign exchange, and I don't know if you are US based, but if you are based on a small island, an open economy like me, the inflation or like the devaluation of the money in your account comes from not salary increases as the quantity theory people believe in general, but from the changes in the currency exchange rate. So how can you link that to your real production thing? I fully agree. That's the other side for an export of a country and the real productivity and increase in productivity. And this brings to my last point in my last minute. This is not an easy stuff. I don't give you any easy answer to it, but I'm pointing to the weakest parts where we all have to help out on building on. And that is to say that my last point, if we solve all these, then we have the issue coming from the point of the Fiscal Council where I am, where you have the state money, and we see this very clearly now in the COVID crisis. On top of what has happened since the financial crisis of 2009, and in the last 11, 12 months, we see all treasuries of all countries creating more money, almost endlessly, and not really from a real productivity increase more than into the future and hope of the running of the economy. And I will leave it there. Sorry for the
No, you don't need to be sorry. Thank you so much. It was very detailed comments and discussion. And in case you have time, I would be more than happy if we could read your comments in a written format. And let me now give the floor to Maria. Maria used to be the coordinator of the Finance and Law and Economic Working Group of Young Scholars Initiative, and she has a law background. And please introduce yourself, how you are connected to the money view concept, and please give your presentation. Thank you.
Yes. Thank you, Adam. Hi, everyone. I would like to share my screen. Is that, did you see my request? Did it come through, or how's that? Is it people actually seeing my screen now, or how's that? It's fine?
Yes.
Yeah. Okay.
Yes, you can see it.
Okay, wonderful. So thank you very much for the opportunity to present here. I'm excited to be here, and I'm excited that we're holding this symposium. I'm going to present you with a puzzle today, a puzzle that I've been grappling with since the fall. And I think it could, or I hope it illustrates and gives you an impression of how I use the money world, the money view, to make sense of how I think of the world, or I basically use it as a tool, and I want to illustrate this to you today. And then I hope to get your thoughts and ideas on how, how to go about it. So what I'm, just by way of background, I am an attorney and I practice capital markets law in London. So that means I'm active as an advisor in the global capital markets. Looking at the global capital markets in my practice, I've come to the view that there's only a very small number of laws or plumbing pieces, pieces of infrastructure that actually produce or are the infrastructure of the global capital markets. And today, I would like to zoom in on one of those pieces of infrastructure and look at the evolution of it, and then pose the question, why was this piece of infrastructure actually implemented at the time, and can the money view tell us a story about this piece of infrastructure? So specifically, I'm going to talk about the registration requirement for broker-dealers under the US securities laws, under the Securities Exchange Act, and about 2 exemptions from this registration requirement, and then ask the question, why were these exemptions granted at the time, and how does this actually make sense? Now, let me introduce you to the general rule, right, before I come to the exemptions. So the general rule is that all broker-dealers must register with the SEC. By all broker-dealers, I mean broker-dealers that have some point of connection to the United States. I have put together a little graph here to illustrate this. So I'm thinking of 2 territories, right? The United States and the rest of the world. And in my example, I have this little factory here who will issue some debt. And it will sell the debt to a broker-dealer that is based in the United States. And this broker-dealer then will distribute the debt in the United States, and it will also distribute it in the rest of the world. Now, I've marked these arrows in red because under the Securities Exchange Act, this broker-dealer here in the United States is required to register with the SEC before it carries out any of these distribution activities, right? And registration means you have to also comply with all sorts of other legal obligations, right? You need to hold capital, liquidity, you need to keep records, disclose all kinds of data about yourself. So a registration generally is very onerous. Now, if you are a broker-dealer outside of the United States, in the rest of the world, the basic rule, and if you are buying debt from this American corporation here, and then you want to distribute this debt either in the United States or in the rest of the world, the United States securities laws say you also have to register, right? So very onerous, and this is what we call the so-called long arm of the United States securities laws. And this was deliberately set up in the 1930s after the 1929 crash, because at the time we wanted very, very strict registration requirements to protect investors as much as possible, right? So obviously, if you are a broker-dealer out in the rest of the world, outside of the United States, and you're buying debt from, say, a French company, and then distributing that debt outside of the United States, you don't need to register, right? Because this is what I marked here in green. So, but whenever you have some sort of connections to the United States and you're a broker-dealer, you need to register. So that's the basic rule. Now, in 1964, the SEC introduced an exemption from this rule. And it said, if you are a broker-dealer outside of the United States and you're selling and distributing the debt of an American company outside of the United States, you do not have to register. So I do have a little graph for this as well, just to make this clear. So I've introduced, this is the same picture as before, but now we have these green, I marked in green when you don't have to register, right? So you're a broker-dealer in the rest of the world, you're buying debt from this American company here, and you're distributing it in the rest of the world outside of the United States, you don't have to register. So that was a big novelty at the time. And basically, this novelty, this rule, this 1964 release, as I call it, makes it easier to distribute American corporate debt, US corporate debt on the globe, right? Outside of the United States. It makes it easier. So now I was wondering, why? What's the policy goal, right? And in the rule that the SEC released in 1964, it says, we're introducing this rule to reduce the United States balance of payments deficit and to protect United States gold reserves. So it's like, okay, how does this make sense? I am drawing a little balance sheet. Now, this is what's happening, right? I have an issuer in the US selling some bonds, so put some liability on its balance sheet, selling these bonds partially to US investors here and partially to investors in the rest of the world. And these investors pay in deposits, right? So the international investors get 300 million, US investors get 200 million. That makes 500 million of deposits on the US issuer's balance sheet. So if you look at this, the balance sheet's balance, right? So my understanding is there is no balance of payments concern here, right? This whole transaction is only a swap of IOUs, and it leaves the balance of payments unaffected. So I thought this doesn't really make sense. Reducing the balance of payments deficit is not what's happening here, because the balance sheet shows there's no reduction. It's just there's no net flow in either direction. It's neutral. However, what is interesting, so let's look into how this does protect US gold reserves. And it does, namely in the following way. So if a deposit is a claim on anyone who holds a US deposit during this time, right? In 1964, during the gold standard era, could walk into a US bank and say, please swap my deposit for gold, hereby I demand my gold, and then walk away. And US policymakers were very, very concerned about drain of US gold reserves. And it was their nightmare that all foreign investors holding dollar claims would walk into American banks and walk out with the gold. So the whole idea of distributing US corporate debt, in my opinion, was to, add, have the swap of IOUs happen here. And because somebody holding a bond, a dollar-denominated bond, cannot walk into a bank and ask for gold. But if they wanted gold, they would have to sell the bonds, get deposits, and then only walk into the bank, into a bank and demand gold. So the whole trick was you are protecting US gold reserves, and namely by adding an additional layer in the hierarchy of money, right? You're sort of pushing foreign investors down in the hierarchy of money. Now, questions that I'm grappling with and I haven't really understood yet, or that I'm interested to sort of hear your thoughts about, is like, why did foreigners hold all these deposits, and did they really hold them in New York banks? So this relates to the balance of payments deficit that already persisted in the 1950s and the 1960s and was increasing at the time. I'm not clear whether during the gold standard era, it was actually possible to have a dollar-denominated account outside of the United States. Maybe some people have ideas about this. And then I wanted to verify whether, because of this policy, actually, deposits held by foreigners, whether they shrank. But I'm not sure how to verify this and where to find data for this. So these are questions I would be interested in discussing with the group or with individually. Before I think I have another 2 minutes. So yeah. I'm also going to touch, so this is the, we had the basic rule, always register. This is the first exemption that was granted in 1964. And then moving on, fast forward to 1989, the SEC released another exemption from the general registration requirement. That's the so-called Rule 15A6. And this rule permitted foreign broker-dealers to conduct certain activities in the United States with US investors. So let's look at my graph, my little picture here. So what is new here now is that I introduced this little arrow here, right? So there's a foreign broker-dealer that is not registered, and it is now carrying out certain activities in the United States. Before, that was not possible, and this foreign broker-dealer would have had to register with the SEC, with the Securities Exchange Commission. Now, why did the SEC introduce this rule, and why did they suddenly allow foreign broker-dealers to become active and carry out certain activities in the United States? Now, in the legislative materials, it says there's an internationalization happening of global capital markets. They're developing, and there is an increasing desire of US institutional investors to buy foreign debt. So if you look at the balance sheet, right, you have an issuer in the rest of the world, somewhere outside of the United States. It's issuing a bond. This bond is sold and then lands on the balance sheet of US investors. And US investors they sell their deposits and swap them for the bond. So what's happening is really this swap of IOU, this is suddenly becoming the trend in the 1970s and 80s, and increasingly so still persisting today. And all the materials, the reasoning in the legislative materials it gives is, it says, oh, capital markets are internationalizing and we need efficient and honest markets. That's what is written in the law. So I haven't really found an answer yet why this is, and how sort of this ties in with the narrative. Like, I haven't really found a factual explanation for this increasing desire of institutional investors, US institutional investors, to buy foreign debt, and a narrative, especially a narrative that ties in with what is indicated in the legislative materials, right? And just to, before I stop, this rule 15A6 that was introduced in 1989, that didn't come very suddenly. There was it was more of a culmination, right? There was an increasing trend in the 1970s and 80s where foreign broker dealers wanted to get market access in the United States. And the SEC had already issued a series of no action letters and granted market access on an individual case-by-case basis. And then in 1989, they said, okay, we're going to create a general rule and allow and provide access for a broader group of foreign broker dealers. And this is why they released this rule. So I'm going to stop here. Thank you very much for your time and your attention, and I look forward to the discussion. Thank you.
Thank you, Maria, and thank you especially for keeping the time limits. Alex, the floor is yours.
Yeah, so this kind of stuff is notoriously confusing for me. Current accounts, capital accounts, what is a capital flow? Which way is the money going? Which way are the debt instruments going? That kind of thing. So what I want to get out of this 5 minutes is not being confused about any of this anymore for the rest of my life. So that's my goal here. I also thought you asked some interesting questions, which I might get to first. So here I'm going to make a fool of myself, and I want to describe what capital flows are, and then you can tell me how I'm wrong or if I got it right. So in terms of the, if we're going to describe the U.S. buying, or U.S. investors buying foreign debt, that is a flow of money tokens going out to the rest of the world, and that is a flow of foreign corporate debt, foreign government debt flowing into the United States. We would call that a capital outflow, correct? You can respond.
I'm going to unmute myself. So I think there's disagreement about what a capital inflow and outflow is, right? And depending on what, whether you do this with a balance sheet approach, or you sort of imagine a picture where somebody is sort of shipping out gold or notes, right? So that's right. Something in general what I wanted to sort of to just bring up and note.
Yeah, so it's interesting because both in a non-gold standard world, both of the base money is a form of government debt. It's a government liability, and then the treasuries are a government liability, and then the corporate debt is obviously corporate liability. So you're just swapping different liabilities from each other. People are trading them with each other. So so I guess my intuition for why they wanted to stop. By the way, I really liked your presentation, and I particularly liked the diagram with the green and red arrows. That was not in your blog post, and I found it very, very illustrative. So that was helpful. Thank you. And the balance sheets were helpful too. So a capital inflow is going to be when the dollars, the base money tokens, are flowing back into the United States, and the rest of the world is buying corporate debt. That's the flow that's going in the other direction, is my understanding. So the idea, and I understand your idea of putting a layer in the hierarchy of money. So essentially, corporate debt is a form of money. Like those are kind of dollars too, right? But they're not base money dollars. They're dollars that are further down in the hierarchy. But they can't be immediately exchanged for gold. And if everybody tried to exchange their corporate debt first for dollars and then for gold, that would move the price of corporate debt. And if you have a run on it, then the price of the corporate debt crashes before we run out of gold reserves. So I think that's kind of the intuition there. Does that make sense? That's how the extra layer protects.
That's how I am making sense to my, yeah.
Okay.
Yeah.
And you were asking about could foreigners actually have deposits in New York banks? And my understanding is that they didn't directly do that. They had euro dollar deposits, like Perry Mehrling talks about, and that is also an extra layer in the hierarchy, but it doesn't have this price mechanism that can protect the reserve of gold. So the euro dollars are generally at par with the regular dollars. So if you have a euro dollar deposit and you want to get your gold out, hypothetically, you could tell your bank to tell its corresponding US entity to do that operation on their end. So then what ends up happening is you cause some actual dollars in the United States to be withdrawn in gold. So I think there is more of a direct mechanism there, and it makes sense that they would be protecting against that by introducing the layer of corporate debt that actually has prices that can move. Does that make sense? Or is that just a bunch of nonsense? I don't know.
Okay, sorry. So, thank you very much for these comments. I think, as I said, I'm presenting this as a puzzle because I think there is some sort of there's a timeline there, right? And so I'm thinking of this as 3 periods, really. Securities laws were put in place in the 1930s, and then the war happened, and this may be, and I'm thinking of this first period until the middle of the 1960s as a period of time where globalization or global capital flows were very, very limited, especially compared to the period in the interwar or the pre-World War I period. And then we see sort of a period between the 1960s and the 1980s where the gold standard crashes and all kinds of things happen, but the very strict regulation that was put in place in the 1930s is still in place. And then in the 1980s and the 1990s, these very strict regulations are being pierced and they're very purposefully rolled back. And all that I see in the legislative materials, when I look, this is sort of my standard tool as a lawyer, right? I read a new law and I go back to what did they write when they put this law through Parliament or through Congress. All I see in these laws, it says internationalization, efficiency of markets, honest markets, that's what we want. But these materials don't really give a reason for what's going on or what's happening. So I need to go somewhere else to find out what happens. And I'm trying to use the money view as a tool in order to do this, right? I obviously need some additional materials. For now, this is sort of how far I was able to take my narrative, right? So the purpose of this session for me is to get some additional input and to read up later. And for you maybe to, for this group, not only you, but the entire group to sort of feedback and give some data points or pointers. And I think this can happen informally in the liquidity session or later on in the open mic. Thank you very much for your time.
Yeah, and you're asking some really interesting questions. Oh, sorry, I guess we're done. Yep.
Oh, yes. Thank you, Maria and Alex. And the last presenter of this session is Asgeir. Asgeir, the floor is yours.
Yes, thank you. Thanks for including me in this session. I am debating whether to use the slides or not, but I prepared slides just with quotes. But what I'm gonna present to you, and I think Adam will share the file, is actually a chapter from my PhD thesis 7 years ago. And it's the last part of the theory chapter in the thesis. So I had a lot of money view also in the first and second chapter of the thesis where I was framing it. But this is where I deliberately tried to flesh out how I use the money view in my thesis. And notice this is in 2014, mainly written in 2012 and 13 at the same time as the course is coming out. So I was following Perry since on the King's College first inaugural plenary of INET in 2010, when we had streaming on the YouTube for the first time almost, before we had Zoom or any webinars or anything. But I could sit in Sweden and follow this. And my claim is, and I've become to realize this even more now when I go back to this PhD thesis that has been lying there for many years, and this is a great opportunity, is that I could never have finished my thesis if I would not have had the money view. I was quite stressed after I had defended it and gave the thesis to Perry, because I wasn't sure if I had misused his money view or misinterpreted it or misunderstood it. But it was by the faculty where I was based, like in the accounting, not really accepted as a theory to use. And I am going to reuse the quote Celine used from Zoltan, where Zoltan Poser said that Perry is not a theorist, but he is a realist. And this was on the Credit Suisse presentation. And I think that's a positive thing, but I try to use it as a theoretical framework, the money view. And the subtitle of my thesis was actually a study of practice. And this is the whole background also of where I came from. I had been in and out of academia in the real life. So at least it's a good theoretical framework for us who try to understand the real world, even though some academic departments don't fully accept it as a fully fledged theoretical framework. But anyway, I included in the file just the prologue and the epilogue of the thesis. And you see from there that I built a lot on Minsky. And maybe I should share the screen here, or I will just give that. I like to just talk and look at you guys while I'm talking, because the slides are mainly like I think the money view as it's presented in the New Lombard Street. There, Perry uses the word the modern money view. He hasn't used it much since then, but I was then looking for the old money view. Where does the old money view come from? But I think it's, originating in Hawtrey, but I didn't have time to go that far back, so I based it mainly on Minsky and Perry's book. So Minsky 1982, Can It Happen Again? And several of his writings where this aspect of the cash flow of the economy comes in. All capitalistic economy is a cash flow economy, and borrowing and lending is the financing arrangement enter into the investment process. And this is what determines the prices of the finance and capital assets. So what I was doing in the thesis was to try to understand the cash flow statements of banks. So very 1.5 minutes on accounting. The balance sheet approach, from the money view, is looking at the balance sheet changes. And the balance sheet of banks expands in its lending. So the money view in the New Lombard Street is on central banking level. I took it down to only commercial banks, simple Scandinavian banks, and the balance sheet expansion through the credit creation, which Minsky explains, but the accounting department had a hard time understanding, was what I needed the money view to explain. And there's a dual effect, and Perry never goes into the income statement, which is another critical feature of the accounting. So the income statement where cost and revenue and the profit is created is interlinked to the balance sheet. So the profit of each year adds to the equity. And this is the problematic dualistic effect of the accounting. In addition to that, we have the stock flow aspect. So you have the stocks on the balance sheets and then the flow from the income statement. And this messes up a lot of people's mind. And originally, the cash flow statement was added to the corporate account in order to see the sources and uses of money, which implicitly in the money view is just used by the balance sheet approach to see where the money is coming in and going from. But in the accounting approach, you have this in the statement and you split the cash flow statement into cash flow from operation, cash flow from financing, and cash flow from investing. And in the bank, the investing is the lending. You know, in a real estate company, the investment is buying a house or real estate, and you fund it by borrowing from the bank or the capital market. And then the operation is the third part where you are gaining or losing money. But for a bank, the lending as an investment messes this up. And the funding can be either from the capital market or the funding can be from the deposit that can be created in the credit creation process. And this is what messes up the accounting and nobody had looked into. But generally, simply what happens is if banks are expanding, if there's lending growth, economy is growing, then the balance sheets of all banks are expanding on average, and their cash flow is negative because the money is flowing out of the banks. But for general firms, negative cash flow, where there's more money flowing out of the firm than into it, is a signal of the core company going badly. It's a signal that the bank would never lend to a company that has negative cash flow. It wants the company to have positive cash flow to lend to it because then they can repay the loan. But for banks, everything is totally different. And this was the puzzle or the mystery that nobody had looked at. And this is what I try to use the money view as a theoretical framework to help me grasp and explain. But then going quickly through to the conclusion is that in order to solve this, we need a new accounting regime for banks. We need to have a different way of doing the accounting statements of banks in order to see the sources and uses of money and what is created within the bank. And that leads to the models that I used that I have presented earlier on YSI presentations of the lending balance sheet expansion and the netting when banks are both expanding and lending to each other and they don't have to send the money, and then the funding if there's an unequal expansion. But that leads us to the capital markets that Perry very well explains in the money view and in the course. So how am I going on time?
Thank you, Asgeir. Do you need some more minutes, or you just finished your? I
think I can stop here, but look forward to hear comments on this. But this was just raw chapter, 7-year-old chapter of how I tried to use the money view. But it was really great to go back to it and try to make sense of it now again.
Okay. Thank you, Asgeir. It was great. I really liked it. Before I give the mic to Maria, let me inform you that since the happy hour of liquidity has just started, I have a very, very good thing to share with you, that since Perry is here with us and he is going to comment the 3 presentations soon, and then after we are going to open the Q&A session. So Maria, the floor is yours.
Thank you. So I'm going to do this Q&A style and just poke you a little bit, Asgeir, to tell us a little bit more about what you actually did and how you think the accounting for banks needs to change, right? So the first, I basically have two questions for you. The first one is, so we all know how to draw a balance sheet, and so this is one of the very basics of the course, to draw several balance sheets and understand what's going on in a particular transaction. So now, how would we do this, or what's the, why is it, how would we do this in, like, if we were to draw a stylized cash flow statement, how would we do it, and what would it actually help us doing? So I think the greatest difference in the balance sheet and the cash flow is that one is sort of a snapshot, right, in a particular moment, and the other one goes over a particular time. So if you were to explain a little bit, like if we how to draw a stylized cash flow statement and what's the purpose of it. The second question is, if you were saying we need a different accounting for banks, and I think some central banks, the Bank of England in particular, has taken up this discussion in some way or another, and maybe you can just share a few updates on where the discussion currently stands, and why also there is a, I would say, vested interest in not sort of proceeding with this new style of accounting that you are advocating for.
Yes, okay, thank you, wonderful. I mean, obviously I failed in the 7 years to fight for this change of the accounting standard. I was fighting the International Accounting Standards Board and the Financial Accounting Standard Board of US. So, but you're right, Bank of England was open to it, and Andy Haldane was actually the only source I had who had said in speeches after the financial crisis that we need that. Now, to go first to your first question, I know that both Perry and Minsky say, think of all firms as banks, you know, because the money is flowing in and out, and you can even, you know, through the accounting of firm accounts payable, accounts receivable, look at every firm as with a kind of a banking operation in it that is affecting their accounting statement. But that is dealt with in the working capital, in the accounts payable, receivables to net that out. So I'm fighting the guys that I like. I mean, the guys I quote, Perry and Minsky, in this respect, to say that the banks are different. But the key here, in my view, is that, and this might link to the first presentation, when the part of the bank is the money or the cash, then that affects.
I missed that. You were talking about my
when
presentation, but you broke up. Can you say it again?
I broke up? Okay, sorry. Yeah, so I think there is a linkage here between the presentations. You know, that what I am saying. Now I lost the thread. The key problem is the credit creation that happens in the bank that other firms cannot do unless on a small scale. But the key is the deposit that the banks create when they create the loan, and the deposit is a big share of the liability side of the bank. And for a normal firm, the money is not only unit of account, but it's also their sources of funding or financing, like the real estate firm that's buying a house and getting a loan from the bank. And then you can see in the cash flow statement that is split in three. cash flow from operation. So what's really whether they are generating cash or not from their operation, cash flow from financing, and cash flow from investment, because they could be increasing their cash balance by selling assets, and that's not really from operation. Or they could be increasing their operation, but by funding it with loans. So they are growing, but they are taking on more loans than the actual growth. So they are hiding their losses. So that's why you have this third statement, which is the cash flow, and you need to look at them all three in articulation. No one of them tells you the whole truth. And then on top of that, you have the finance view with the free cash flow, which is a totally different thing, expected future cash flow, and the free cash flow, which is not the same as you have in the cash flow statement in the financial statement in the accounting view. So there's a lot of messing up with the complicated concepts. But what I would, to go back to the answer, what we need to do to see this better, and that's the challenge that I haven't managed to solve on my own, and I don't have a fellowship to do that, is that if we can separate the actual credit creation in the bank from their expansion that they fund with external funding, you know, how much of it is refinancing of existing loans, you know, so the balance sheet growth, you're disentangling where the money is coming from and what it is going to. And so we need some different classifications of it. So basically, in the accounting view, or from the accounting perspective, try to separate what's created within the bank with new lending and deposit creation, what's created on the money market, how much they are funding, how much of the funding is refunding of existing, you know, and this is very, very complicated thing, but I think it's possible today with better technology. I think it was very hard at the time of Minsky, you know, with old style accounting, but the solution needs some creative thinking, and on top of that, you know, linking back to my current job and my comments on the first presentation, when it's not only the banks who are creating money, but also now the government creating the money, that messes things up, you know, because that's the new money flowing into the financial system from the treasury, you know, and then you need to separate that, the new governmental high-powered money being created, and how much of is then created by the banking system through support of central banks, and how much is created through the normal actual operations of banks through their lending based on their own equity and balance sheet, you know. So this is kind of my big complicated view, and yeah, I think it links to both of the question. I think in order to make it work, it actually has to be a coordinated effort of the central bank or the supervisory authorities and the accounting standard authorities or regulation, you know, jointly in order so that we can separate this. But maybe I'm a dreamer, and it will never be done, you know.
Okay, Asgeir, thank you so much. And let me give the floor to Perry. Perry, in case you have any comments regarding Celine's presentation, you can also make some comments on her presentation too. Thank you.
Celine's, I only saw the very end of Celine because I was and I had seen that presentation before, actually, in Chicago. So there are many things to say, but I will say maybe one or two things, because you don't want to stand between. I don't want to stand between you and your liquidity. Maybe in reverse order. Okay, so because I think I can link some things up here. So Asgeir, yes, banks are different. Okay, you are not opposing me in this regard. Okay, when Minsky is saying we want to think of firms as banks, he was saying we are doing corporate accounting wrong. Okay, we need to be thinking of everyone as if they are a bank, and we need to think of banks in this particular cash flow way. There are two Minsky references or more. He proposed an accounting system for banks in 1965 for California when he was at Berkeley. And I see there's a reference also in 1975. He is proposing to the government a cash flow oriented bank, and I suppose you know these references because you're nodding them. So he is trying to do what you were trying to do. I don't think he had, I've built out the money view more than he ever did, okay, because he's just thinking of business lending particularly. The key thing in the money view, in my view, is that you're thinking of entities as having time-dated promises to pay and time-dated cash inflows, and they're trying to match these things up. That's the issue. And so that is very difficult. It may be with technology that you can really pay attention to that, okay? And he didn't really do that fully, okay? But that's what you would do if you're trying to. And so that's the first thing. What you do not want to do, okay? And so I'll say a negative word, okay? This book, Banker's New Clothes, by Anat Admati, is basically taking standard corporate finance and applying it to banks and saying they're just corporations. This is just, this is a move in the wrong direction, okay, in order to understand the money view. So I agree, we need new things. The new thing we need, though, is the same thing that Maria is looking for, okay? The reason she is concerned, she's doing some accounting, saying, well, there's no cash flow consequences. This is just a swap of IOUs, okay? So I would refer you, Maria, okay, to Kindleberger 1969 in the Journal of Political Economy. It's an article called Measuring Equilibrium in the Balance of Payments. And he points out that the way we measure equilibrium in the balance of payments, we distinguish short-term capital flows and long-term capital flows, okay? And what you're talking, and the liquidity measure would view this, so he thinks we're doing balance of payments accounting wrong. And why? Because the United States is a bank, okay? The United States is a bank, not a corporation. Okay, and so that I think will help you with your. In fact, let me say one more thing. So I think this 1964 proposal that you're saying is very much part of this package where the politicians are all worried about the deficit and stuff like that. And they're worried for the wrong reasons because they don't understand the balance of payments in a country like the United States. That's Kindleberger's main thing. So connecting this up with the interest equalization tax of 1964, the voluntary capital flow restraints, this is part of the same response to this pressure. It sounds to me like that it's not an accident that it's 1964. 1989, I would say, is a separate thing. Remember, by then, the whole Eurodollar market has grown up abroad. Okay, the whole Eurobond market has grown up abroad. Everyone is borrowing and lending in dollars in Europe. Okay, this is what Kindleberger thought should be happening in New York. Okay, what your 1989 rule does, okay, is to basically make it happen in New York. Okay, that you're reverting to what it should have always been, which is if you want to issue a dollar-denominated bond, you can issue it in New York. Okay, why are they issuing it in Europe? Because of all this restraint, this political restraint. This is a workaround. This is a workaround for that sort of. That's because it's now globalization and so forth. Just answering one of your factual questions, yes, foreign banks and foreign central banks have deposits in New York, okay, in the 60s. They're using them as their international reserves. The basis of the offshore Eurodollar system is these reserves. They're using deposits. I have a lecture on this. It's actually in a MOOC, which is available for free. It's called the Eurodollar. Okay, it's very early in the MOOC. Okay, and then it later comes back when you're doing foreign exchange. So this about exactly how the Eurodollar system works, because they're using it. They're basically running a monetary system with almost zero reserves and no access to the Fed. So there's a lot of very interesting banking involved in that. Now let me finally say a word about Alex. So Alex has discovered the hole in the money view, okay, which is that I haven't really extended it to talk about the price level, okay, and he wants to fill this hole, okay, with something. I'm not sure this is the right thing to fill it with, okay? And I'm going to say a word or two about that. But he's right that it is an open project, okay? And the reason I have some concerns about what he's filling it with is because it's there's sort of quantity theory stuff sort of sneaking in here. There's Jevons, medium of exchange. So let me, and I understand the impulse to say we want to really care, what we really care about is the real economy, and so we care about the interface with money. But if you look at what money does, and you say money is what money does, if a Martian came and looked at what money does, you will see that almost everything that money does is buying and selling financial assets. Okay, buying and selling goods is a very, very tiny fraction of what money does. Okay, so what the money view has tried to do is to build an understanding of how that system works, treating, kind of ignoring the buying and selling of goods. And when you do that, you see that the essential feature of money is that it's a means of payment. It's a means of settling debts. Okay, this is what Hicks says in the market theory of money. And then once you have that, it's natural that people will use that also as a medium of exchange, also as a store of value. Okay, but the means of payment, the means of settlement, is prior to those things. At least that's how I have built the course, and built the whole thing on that. But it is a whole. I don't have a theory of the price level, really. Okay. And I can imagine a couple of directions to go, but I do not think that you can think of it as something, an exogenous building block on which you can build. It's going to be endogenous, okay, and it's going to be determined by the same kinds of things that are determining the other prices of money. And there's going to be dealers in raw commodities and things like that, And that story that I told about the Great Depression this morning, okay, is about the collapse of the price level, driven by the collapse of commodity traders and dealers in coffee and whatnot, worldwide, and or oil or whatever, that. So that's a money view style story about price levels. Just as Asgeir's story about foreign exchange, is a money view style story about the domestic price level of Iceland. And there are such stories about the German hyperinflation. There's a foreign exchange story about the German hyperinflation. Not that they're printing presses, but in fact it was about the survival constraint and the collapse of with the pressure of reparations and everything. So these are deep questions, and I don't know the answers. So it's open, and that's what I love about this. Seems to be an open architecture on which, as Adam was pointing out in the chat, people from people find it useful for the problems that they're working on, and it's very primitive. So it's not involving a lot of other assumptions and things. I think that's why it can be a kind of it's a fundamental building block, and you're looking at these and cash flows as the fundamental real thing in the economy. Income is not. A lot of income is like imputed and stuff like that. And so GDP numbers are, you want to measure that stuff, but it's mostly trying to measure solvency. And solvency is an accounting fiction. Okay, liquidity is a market fact. Okay, that's a little meme. Okay, get that one going around. Okay, that's all. I don't want to stand between you and your liquidity. We could talk about this for hours and hours, but that's just to try to poke you in certain directions.
Thank you, Perry. Thank you so much, and thank you so much for the panelists. And I would like to ask Jay about the end of today's program. Should we have a little break of 5 minutes and then come back, or what do you suggest?
So I have actually intentionally not filled this program with any detail. So it's really what the participants want to make of it. And I do feel from the energy in the room, my impression is that there might be one or two reactions that we should maybe warn from the panelists based on the comments. I know Alex, for example, has had very little chance to respond to things. So that would be maybe first point of order. But then I would also point to the fact that we had a tremendous discussion in the middle of the day that I feel like some of us want to maybe recap the others on, just to give us a sense of what happened, because we've had a full day of discussion, in particular after the icebreaker. And I'm really surprised how much energy I still have after a full day. And I think everybody is still here after 150 people here were initially, but people are still here. So I feel my concern about keeping things tight and structured are not as important as I initially thought. And I would just welcome anybody to bring up any points you have. But I think maybe, Adam, if you want to just finish off the session with the panelists, quickly wrapping up their final comments on what Perry and others have said, and then we can sort of maybe, I think Alex is also in a very good position to maybe recap some of the discussions that happened, to just bring everybody up to speed.
Yes, thank you, Jace, for your suggestion. And Alex, would you please reply to the comments you received?
Yeah, for sure. So Perry Mehrling, to respond to his comments a little bit first, he mentioned that he saw a little bit of quantity theory creeping in to my talk. And I want to draw the important distinction between quantity theory and, price level stability in general. I generally do not subscribe to the quantity theory. I tend to pay attention to more like the income theory of money, or the income theory of prices, which I actually found out about for the first time reading your book, The Money Interest and the Public Interest, where you mentioned this guy, this French economist Albert Aftalion, who I found basically no other references to, who talked about the income theory of prices. But it's this idea that there's always money flowing through the economy. So instead of there being a certain amount of money that just kind of spreads itself out evenly, and then sometimes you have to add more or something like that, money has kind of a source and a destination. It flows from consumers to producers, and this is all in the goods market, right? This is maybe not as relevant to the money view stuff, but the goods market is important too, and we wouldn't have money if there wasn't a goods market. So even if it's a very, very tiny fraction of the total amount of activity, it's still very, very important. Like when we were on a gold standard, even though gold was a very, very tiny fraction at the top of the hierarchy, it was still very important to make the whole thing go. And what's really at the top of the hierarchy is not gold, it's goods, right? Money is an IOU, ultimately an IOU for goods. So that's what sits at the top of the hierarchy, and it's very tiny in terms of volume maybe, but everything else kind of is based on that. So that's kind of my response to that. And in terms of what the price level, where that comes from, it's about matching up the flow of money with the flow of goods and services, and making sure those things are balanced with each other. So that means that consumers need to have a source of spending power, a source of purchasing power, and that's what allows them to spend and activate kind of the economy's productive potential. And you just want to keep those two things balanced. So that perspective works even if you imagine a world where producers are just accumulating money forever. They're producing things and then hoarding the money. As long as the consumers have a source of money, that can keep going forever. So that gets kind of into the basic income stuff. The economy needs a source of money, or consumers need a source of money in order to keep spending. And if we're using monetary policy and other kind of macroeconomic policies, or any economic policies, really to kind of create jobs and push money to consumers that way, and if you're doing it for that reason, then you're not necessarily being the most efficient you can be in your labor market or in your financial market, right? Like if you're, like I talked about the tension between the Fed having to keep interest rates low to prop up the price level versus wanting maybe higher interest rates to rein in the financial sector and the expansion of unstable private credit and that kind of stuff. So if you have something like a basic income, that allows the Fed to raise interest rates. So kind of this is one of the questions that Asgeir had, which was who's managing what, right? Who's managing the money? And I certainly don't think the money manages itself. I'm not, and I don't think something like cryptocurrency that's unmanaged by institutions could ever really work. You need a central bank, and you need kind of institutions kind of managing those flows. So if the fiscal authority is spending more money into the economy and basic income or otherwise, and funding consumers directly that way, that means you need less of overly expansionary monetary policy to make it easier for firms to borrow and employ more people and kind of push money to people that way. So you can at the same time, you can have elasticity and discipline at the same time. You can expand the top of the hierarchy at the same time that you kind of tighten the bottom of the hierarchy. You can tighten the credit market at the same time you expand further up. So you're kind of narrowing the pyramid without kind of collapsing the whole thing, if that makes any sense. In terms of Asgeir's other questions, do we need a stabilizer of last resort? So yeah, I mean, we want the financial markets to be stable. We want smooth operation of all of that. And the question is, who does what? So if you put the Fed in charge of keeping, or central bank, I should say, if you put the central bank in charge of keeping at least the domestic financial market stable, then that frees them up to not have to worry about the price level. So that if you're saying you don't have to worry about the price level, but someone does have to worry about the price level, so then that would kind of fall more on the fiscal authorities. So that's kind of a imagining of things working differently than how they do now. But there's also this, why do we have the business cycle? Why do we have this cycle of booms and busts, the credit cycle, all of that? Minsky would say it's just inevitable that, financial instability just accumulates and you can do things to kind of like mitigate it, that kind of thing. I would say that it's a consequence of the fact that we are overstimulating the financial sector as a way of pushing money to consumers. And if you have a high enough basic income, you don't have to do that anymore. And the financial sector can be about actually real productive investments. And he's questioning whether the legal story really isn't not enough, or whether the legal story really isn't enough. And I would say, yeah, I mean, you have to have some theory of what the legal system is reaching for. Like earlier in the day, Perry Mehrling was talking about how a lot of these systems were kind of evolving and they're trial and error. Well, there's something that's putting kind of those constraints in which the evolution is happening. And for me, for money, that is kind of this for the price level. That is kind of this, or not just the price level, but the reason why we have money is this computational complexity problem. So we have to be solving that problem. So in order to understand the legal history of money, you have to put it in context of what is the problem that the laws are kind of evolving to address. So legal history is interesting and it's important, but you can't have the whole story. You can't end the story of money with the state. The state faces constraints, like actual constraints on what it can do, because the market has this very specific problem that needs to be solved. And if the state doesn't orient its laws and institutions around solving that problem, then you're gonna run into some problems there. So I'll stop there.
Thank you so much. Let me open the floor for any comments and questions for the audience. Is there anyone who want to speak?
Can I just the one thing? So somebody said here in the chat that you cannot use balance sheets to show a flow, right? I don't know, I can't find so that was about my presentation, right? Because I had the slide that said, the balance of payments is unaffected by this policy because the balance sheet's balanced. So I think this comment makes sense, but I'm still confused. So if the person who made this comment maybe can explain, I think they're called Ritvik here so.
Let me explain from the accounting perspective.
How about having the author explain it? Sorry, sorry, Asgeir. Like, is that possible? Or maybe just one-on-one and in email is also good. I don't know. Or maybe, sorry, Asgeir, but I was like. Okay, maybe somebody else wants to go first and then this person comes in.
But you almost had it yourself. I mean, the balance sheet is a picture, and the change in balance sheet between 2 points in time is the flow. So the cash flow is the change in the balance sheet from one point to another point.
So nobody's talking, but Win Monroe has his hand up, so why don't we go to him?
Yeah, so on Maria's question, I don't have a comment, though I think what Ritwik was saying was a little bit different than just the distinction between like balance sheet as a snapshot and flows. I mean, I think it has more to do with like netting, but I'll let him comment on it at some other point. No, I just wanted to ask a couple questions or make a couple comments on some of the presentations, which I thought were really interesting. So for Maria's thing, one thing I said in the chat, which was thinking about the kind of monetary motivation, especially in the kind of like Eurodollar market. I think the presentation from Catherine Schenk tomorrow will talk a little bit about developments in the Eurodollar market in the 1960s. I just know that that's kind of her recent research, so that'll be super interesting and maybe relevant for thinking about some of that. And then for Alex's, I had just like a couple thoughts and comments. One of the things I mentioned earlier was that, you know, coming from working at the Fed, I feel like you get a lot of this view and it comes very naturally, and you read things like Stiggins. And then now that I've kind of moved to a more academic perspective, it's often difficult to like figure out how to map some of these ideas, you know, into kind of more orthodox macro or financial theories. But that sometimes there are linkages, and, you know, even if that school is not always reaching out, that sometimes we can potentially try to find ways in. And so when you're going through your talk, there are several things in the kind of more, you know, orthodox academic literature that came to mind. And I just wanted to mention to you that you might want to take a look at and see if, you know, you feel like you can speak to them, or if they speak to some of the stuff you're talking about. So one, when you're talking about money as kind of like a token for coordinating things, this reminds me a little bit of a more recent kind of monetary theory called New Monetarism. In particular, there's like kind of a group of models by Lagos and Wright, where they basically say there's like a market for goods and a market for like payment tokens. And the payment tokens help people coordinate the double coincidence of wants. They, you know, some people go on and develop very complicated computational stuff for this. But the very basics of the model, I think, are interesting, maybe speak a little bit to the way that you talk about some of these things. Second, when you talk about the importance of a stability for payments, you might want to take a look at some of the stuff from like Gary Gorton, for example, who talks about information sensitivity and why, you know, debt and credit is, you know, particularly information insensitive and therefore good for, you know, being used as like a payment method. And then the last one, which is not really from the kind of academic economics world, but, you know, I think you mentioned a couple times that there's this like deep link between money and goods, and you know, clearly there is, but it's not super clear to me that really they have to be fundamentally linked. And so like I'm reading Graeber's, you know, 5,000 years history of debt. And in there, he talks about these like social currencies, for example, which are not used at all for any kind of exchange. And so I think, you know, whether the link between goods and money has like some fundamentally important, you know, feature to it for kind of your view, may still kind of like need to kind of like come to terms with the idea of like where and how money is used when it's not for like commercial purposes or just, you know, transacting in goods and services. So yeah, those were kind of my like thoughts as y'all were going through. Thanks.
Thank you, Wim, for sharing your thoughts. Chris, could you please share your comments?
Hi, yeah. So I was going to say just how much I appreciated the presentations. I thought they were all excellent, and I learned a lot from them. There was one comment I wanted to make on the. I've always been a bit uncomfortable with this, the idea of the hierarchy of money. You know, the slide where you have gold as or US dollars as the asset of the central bank, and liability of sorry, the liability would be cash, and then a retail bank has cash as an asset, and then deposits as a liability and so on. One thing that I think it would be interesting for people to consider is the sort of implication is that things get settled in the next level up. But actually, I think if you looked at how most loans by a retail bank get settled, they mostly get settled by writing off the deposit, not by any actual transfers of cash, I believe it would be true to say. So you don't actually need the higher level of money in order for that settlement to occur. So when you think of a loan as an exchange of IOUs, the settlement can just as easily be undoing that by a simultaneous write-off of IOUs. So that's just something for people to have a think about.
Thank you, Chris. Let me just conclude this session and close the session by stopping the recording. And after this, the link is going to be open, and the discussion is going to open. And if you want to stay with us, please stay. And thank you again for the panelists. Thank you again for Céline for the introductory lecture, and for the comments of Perry and the others also. And